I just invested in these 5 companies coming out of the magic formula. For those of you who don't know what the magic formula is, it was first introduced by Joel Greenblatt in his book, The Little Book That Beats the Market. This was back in 2005, and he noticed this was working out very well and became very popular. So later in 2010, he again took on another book and he named it The Little Book That Still Beats the Market. So what's the sketchy title about? He basically gave a preface that if you bought companies, just looking at 2 important points. One is the cost of the company based on the earnings. So you're basically trying to find cheap companies. Well, they may be good, they may be bad, but cheap companies. Second, you're trying to find companies who are doing a very better level or better than average level of capital allocation. Based of amount of capital needed for the company to generate profit. So those are the 2 things that you were looking. And if you ranked all these companies in the market based on the amount of earnings that they're making based on the capital allocation, you could find some good bargains to buy. And he created this website called the Magic Formula Investing. It's a free website. You could just simply create an account and look up all the companies that the formula is promoting or taking out. So this quarter, as of today, if you look up and if you give a minimum market cap, so you say, okay, I'm only interested in these companies that are trading at about more than $1 billion. So you just put in 1,000 million and it'll give you all these stocks that are trading at more than $1 billion. You could give a lower multiple as well. You could put in 100 and it'll give you a couple of other companies. Lower the multiple, higher the volatile nature of the company. So in that perspective, based on how much risk you're interested in, you could go ahead and put in your multiple. And you could just simply come up with all these companies. And then he said, based on these companies, just pick up about 20, 30 companies in a year and invest them over a period of 1 year. So don't buy all of them in one go. Buy them over a period of years so that you can take advantage of the fluctuating nature of the market throughout the year. There will be some booms and busts across the year. You're just taking advantage of that. So the idea is to buy 5 companies every quarter and see how it gets invested. I was first introduced into this technique by another YouTuber, and his link is down in the description below. And he's using the system, but he made a little bit of a change in it. He's not just investing into it, but he's also adding a few tweaks in it. And I'll talk about these tweaks in a little bit. So you're basically pulling up all these companies. And this is an Excel spreadsheet. And if you're interested in this, just leave a comment in the below. And if you're interested in taking the spreadsheet, I'll share the link with you. So you're basically going through all these companies and trying to understand which companies you want to own and which companies you don't want to. So I went through all of them, and here are my notes. And based on certain criteria, I shortlisted some of the companies that I wanted to. So yeah, if you just click up here and I filter by color. So these are the 5 companies that I went over with. So Buckle, Innoviva, Medifast, Cigna, and Dish Network. Just to give you a simple example, Buckle, this is more of a retail brand, in the designer clothes and other things. The insiders own about 40% of the business. There's a good article on the Value Investors Club, which is also a website run by Joel Greenblatt. The company is not growing so much, but there seems to be very good level of reviews on Google. Then you have Innoviva. This is a spin-off from another company which was into making treatment medicine or medications for asthma. And this is basically royalty-based company which is just collecting royalties, and they're then investing into other companies. Then you have Medifast, which is another pharma company. Then you have Cigna and Dish Network, which is trading at a very low multiple, thinking that Netflix and Amazon Prime will take over, and Dish basically people will go away from the television, the old network television. So there are certain reasons why these companies are trading at a lower multiple. They are not as popular in the market as the EVs and the other high-flying companies that we come across. But going through all these companies, you come across very different ideas where insiders are only owning less than 1%, less than 2%, and they're massively selling There are no super investors involved. There are a couple of other problems that you think and look up, and you're not so much attractive to these companies. So looking at all these factors, there were 5 companies that we shortlisted and went about and bought in this particular portfolio for this quarter. Now, you'll notice this particular company, the magic formula gives us about 30 to 50 companies to invest. And this spreadsheet has about 80 companies listed here, 88 companies. And for the reason for that is there is another website called the Magic Diligence website. And here they pull up the similar technique. They're also claiming that they are also following the Joel Greenblatt's magic formula investing with a little bit of tweaks of their own. And they give their own list of companies to go with. And they're claiming that their magic recipe is giving a return of 100%, which is a huge big deal. It's a little bit difficult for me to digest it, but still, the idea was to look up into all these companies as well and then compare with the magic formula and go with the companies that you want to really invest. Now, the magic formula, yes, it does claim that it beats the market, but at the same time, if the market is going down and say it's trading at about less than, it's down by 40%, your magic formula portfolio will also be down. So it's not always, rise and shine. It's not always sunshine over there. There will be some lows as well. So it depends, but it's very interesting. And look, basically, the idea is to see how it compounds over a period of time. Now, the tweak that we are doing in this particular section is the magic formula says that you should sell your companies, especially the companies that are making or giving you a loss. You want to sell them and gain some tax advantage in that. And the companies that are winning, you should sell them after 1 year. So you could take advantage of the corporate tax. But at the same time, it asks for you to sell these companies after 1 year. But in order to take the full advantage of the compounding nature of business, because you'd never know what companies you're buying, and some companies might do very well. Back in the day, if anyone knew Amazon could be trading at $3,000 today, people would have invested in it and kept on to it. So that was the idea, just kept on to it. And you should not sell, you shouldn't have sell Amazon. And these things happen, and you have no control over this. You just basically, the idea is to buy them and not sell them and go on for a good amount of time. Now, when do you want to sell them? You want to keep a check for yourself. You're either looking it up on a quarterly basis, or you're monitoring the growth of the company and seeing whether it's worth selling or not, whether the growth cycle has died, the company is gone. So those are a few things to keep an eye for. So just wanted to share this with you. If there is any interest in this, let me know and I can go over a little bit more in detail about these.